All right, I'm going to show you the hardest and most important step of the Diamond Wealth real estate system, which is the best system in the game. I say it, I mean it, and I show it because the proof is in the numbers. The numbers don't lie. So the final stage of the process is when you take that hard money loan or your own money that you slapped a loan against and you refinance it from the traditional bank, pay it back, so you have structured permanent financing for your income producing, cash flowing house. So I'm going to take you through, show you how I do it, my personal preference. I use DSCR, debt service coverage ratio loans. I'll explain why. Mainly because you can only have 10 according to Fannie Mae. You can only have 10 finance properties, and that's it. After 10 per person, you have to go into a commercial product. So I'm going to show you a deal that I just finalized, and my loan was $245,000. Now, it was obviously I'm using the DCR ranges. You're familiar. I overfund, and it's all done right. But the final stage is you have to pay that money back. So I was at 8%, tax and insurance. My total payment was this, and rent is $2,900. So the old cash flow was $1,173. Now, how do you take that and refinance it? Well, my preference, like again, I say DSCR, debt service coverage ratio. So it is a ratio. It is a very straightforward mathematical process to calculate whether or not you will qualify. The simplest way of explaining it is you take the net operating income and you divide it by the debt service. And now the ratios, depending on the lender, you should be hitting between 1.25 and about 1.3 on that ratio. So the way I do it is I take 15% off the top. Some lenders, you got to check with your lender. Some would be higher, some would be lower. So if you take 50% off the top, meaning you take the gross rent and you multiply by 85%, so 15% off the top for expenses, you become at 2465. Now divide that into your new payment. Now I'm going to show you how the loan goes from 245,000 to 255. DSCR loans are extremely expensive, so it's about $9,000. Let's take a look at that settlement statement. So 255. I want to show you how expensive these loans are, but why it still pencils. It's a one-time expense. Don't worry about it. It's 7.5%. Now that is when you have the best credit and your ratio is the best and you have good reserves. You need about 3 months of the payment per house to show in seasoned reserve. So this is the most important step because you have to be extremely organized. Number one, you have to have reserves, and not everybody can do it. And the reason they can't do it, they're disorganized, their credits are a mess or whatever. So you're making it work on hard money, which is not a sustainable long-term plan. But let me show you. So 255, you get all the fees, origination fees and broker fees and appraisals, third-party fees, et cetera, paying back the 245. So we're taking out a new loan of 255, paying back the 245, and then I'll get back $939, meaning with everything, it's going to cost me about $9,000 to do this. But again, it has my impound accounts. What is an impound account? It is your tax, insurance, and I no longer have to make manual payments for that, which is absolutely amazing. So as you can see, this is how much it costs for a DSCR loan, which is why we go from 245 to 255. Now, my new payment, 7.5% PITI, which means it's fully amortized tax and insurance, is $1,875.92. And the payment letter, we just did it. It looks like this: tax, insurance, principal and interest. And here's another one. Your loan does have a prepayment penalty. Most DSCR loans will have a prepayment penalty between 3 and up to 5 years. It keeps going down. It's based on points, percentages. But then again, I'm okay with 7.5 for the time being. If rates drop down drastically, which I don't see it happening, especially on the commercial products, then we can reevaluate and down the line refinance. But for now, we're going to make it work. So let's take a look. What happens to our cash flow? Well, our old cash flow minus, so we had tax, insurance, and interest was $1173.75 per month. Pretty good, but no principal pay down. So the loan stays at $245. Now the new one at 7.5%. This was here, it was 8, and the new one is at 7.5. Now the new cash flow is $1,024.08. So the difference is $149.67. However, since we're now fully amortized, one of the second best way of making money in real estate is principal pay down, as I describe it in the book, right in here. You see this? Principal pay down. So your loan is going down with every single payment, meaning your net worth is going up. Absolutely incredible. So even though we have a difference of $149.67, technically less cash flow, it's now permanently fixed. Obviously, rents are going to go up, but my favorite part, one of my favorite parts of making money in real estate is this. This is what the amortization schedule looks like. And as always, the interest is front loaded, meaning on the very first payment, you're going to pay a lot more interest and a tiny bit of principal. And on the last payment, you're going to pay all principal and very little interest. Why do they do that? Because the banks are smart, front-loaded interest. It is a great for them, because if you're refinancing every 5 years, 6 years, you've paid the worst part of the interest. So the banks always win. So don't try to fight the banks. They're going to win. We work with them, use the system, and we can still be extremely successful following their rules. So let's take a look. Out of the first one, on the first payment, we're going to have $189.25 of principal pay down and $1,593.75 of interest. That's payment one, and then it's progressively going to get better. Now, if we go back, our difference was $149.67. So we're already making more money in theory because we have this principal pay down, which means the loan's going to go down every single month. Now, if I go down to the very last, so let's remember this. This is what front-loaded interest looks like. This payment one, and if we go back to the very last payment, which should be, let's see, on 360 here, look at this. The principal is $1767, $11 of interest. It's just what it is. They want to make sure that you pay all their interest front loaded. Most loans are like this. So if you didn't know, now you know. And that is another reason why this part of the process is so important, because we got to get in permanent financing. You don't want to be making it work on hard money for more than 3-6 months. It used to be 6. You can refi them now in 3 to 4 months seasoning. So it is, again, you have to get all of your books in order. You have to make sure your bankability is on point. You can't, and if you have bad credit, you can't get this to work. So don't live your life with the handicap of bad credit, unorganized financials. Just be organized. Talk to your lender, whoever it is. If you're under 10, of course, you don't have to go into a commercial product. It's going to be a little cheaper, and your rates on the first 10 are going to tend to be a little better. I think they're about 7.17%. So it's huge. It's a big difference. But then if you're over 10, my preference is DSCR. Now, you can do different loan products. The reason I like DSCR is because you can take that and have it in a single house. It works just like any other loan. So the only difference is it's commercial, it's got prepayment penalties, it's more expensive at higher rate. My preference, I like it. It moves faster, 3 to 4 weeks, and you're done, as long as you have everything in order for your lenders. Again, bank statements, seasoning, leases. Another thing that's very important is you have to prove your rent income. So let's say your tenant pays you this $2,900 in cash, and you have to go to the corresponding bank and deposit it right away and keep that receipt, because the lender will ask for proof. Another thing they'll always ask is proof that you've been paying your old lender. So organization is key. but this is the most important part of the system. And once you get this down, you will have infinite wealth and 7 different ways of making money in real estate. Nothing like it. So make sure you buy and hold your assets, which is the hardest thing to do. And good luck.